Welcome to my Juris Wealth clients and friends. For this quarter's market update, I thought we'd do something a little bit different. Whereas previously we've hosted live market update webinars, going forward, I thought it'd be more efficient to simply record a 15 to 20-minute conversation with my partner and colleague, Charles Blankley. That way you can watch the discussion anytime that's convenient for you. As you all probably know, Charles is our Chief Investment Officer and the head of our investment committee. And as Charles and I were just talking about, if you can believe it, he's been with the firm for nearly 25 years. Charles, I'm going to turn it over to you. And while I may have a few questions as you go through, this is primarily going to be your presentation.
Great, thanks, Tim. Hello, everybody. And as Tim said, this will be a quick review of what happened last year, and we'll offer some thoughts on what we think's coming ahead over the next 12, 18 months. I'll work through the material pretty quick, but if you have additional questions, throw them out to Tim, and we can always hop on a call at whatever point you'd like to. So first off, last year was a good year. So all the equity indexes were up double digits with the exception of the emerging markets. Global equities were up over 20%. Russell, which is the small cap index, was up close to 17%. And the international EFI was up a touch over 18%. So one of the big economic stories last year that drove the solid equity market returns was the decline in inflation. So you can see that second box, inflation fell from 4.7% at the end of 2022 to 3.2% at the end of last year. That was a big decline, and basically inflation has been cut in half from the highs. And so what it meant was the Fed sent a signal in the fourth quarter last year that they may cut interest rates in 2024. And that was the trigger for a decline in bond yields in the fourth quarter. And there's a pretty sizable decline in bond yields. Year over year, they didn't change much, but you saw a big quarterly decline. If you look at the equity markets, returns were really skewed towards the 7 large stocks, the so-called Magnificent Seven. And so if you look at those 7, so Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla, they were up close to 80% on a cap-weighted basis just for those 7. But if you strip them out of the S&P 500 and look at the other 493 stocks, they were up about 14%. So still a good year, but really the activity and sort of the speculative juices were flowing in a very narrow sector of the U.S. equity market, much of it triggered by, hopes about the AI phenomena.
Charles, what do you say? I get this question a lot, so I'm curious what your response is to those clients who would like to have had a larger allocation to the Magnificent Seven. There's another chart we're not showing here, but all the other stocks in the index on a percentage basis, right, have just underperformed relative to the higher performing ones, sort of as much as any time in the last 20 years or so. So in some sense, we've missed out a bit on the run up in those names. What's the answer to investors on that?
So there's a few thoughts come to mind. One is you own it. We all own the Magnificent Seven and the positions we own, the ETFs or the dimensional funds that we have. They have positions. I think as you say, right, people just wish they had a bigger allocation. So instead of 1-2%, that they had a quarter of their portfolio or some big number in the Magnificent Seven. And I guess that leads you to a few thoughts is, we've all been around long enough. We've seen these cycles of sort of speculative crazes that fizzle out. And I'm not saying that this one is going to, but at least historically, when you get sort of a lot of activity in a narrow segment of the market on, supposed technological changes, stocks get bid up to unsustainable valuations, expectations get too high, and those stocks ultimately provide relatively poor returns looking forward. And I guess that's my other thought is picking tomorrow's winners based on who has won in the past historically hasn't worked very well, right? That it's a cliche, but the past doesn't predict the future. And that's really true when you look at market performance within sectors or look at individual companies. There's no magic bullet, You didn't want the Magnificent Seven in 2022. They were the worst sector of the market. And 23, they were the place to be. So I think for 24, who knows? I think the key is you just don't own too much of it, that if it does get hit, it significantly impacts your portfolio.
Great.
So looking forward, and to sort of build on that same point, is there's going to be a lot of noise. I think without question, right? We're in the middle of a political year, not only in the United States, but roughly 50% of global GDP has an election this year. So the first one was in Taiwan on January 13th, and we're going to have elections all around the world. And then obviously the US election in November is going to lead to a lot of political noises. So one of the messages I want to convey is I think it's really important to tune out the noise in the media. And so I think a way of framing that is to look at just this decade, that if you came into 2020 knowing what we know now, where do you think the markets would have been? So this is not a comprehensive list, but it was some of the highlights of what has happened so far this decade. Obviously, COVID flared up in March of 2020. We had a very contentious election in November of that year, shortly followed by the storming of the Capitol building in January of 21. 3 waves of COVID, the vaccines came out, Russia invaded Ukraine early in 2022, oil prices spiked as a result. 2022 was the year of inflation and rising interest rates. Early last year, Silicon Valley First Republic went bankrupt. A lot of fear, right? Is this going to roll over into the other banks, other major banks? And then sadly, the situation in Israel and Gaza in October. And if you were to look at these headlines at the beginning of 2020, you would have suspected this could be a tough period for the capital markets, but it's really anything but. The S&P is up 56%, growth is up 61, value is up 46. So over this period, the S&P has compounded at about 12% a year, even with all of that background noise going on. And I think that tells us something about the future, that even when there is a lot of cross currents, a lot of noise, that shouldn't preclude the markets from doing okay. And it definitely should be a cautionary tale about doing something dramatic with your portfolio.
Got it. Charles, on this chart, I'm immediately noticing the lower cumulative returns in both value and then small cap, the Russell 2000, and in international.
Yep.
Listen, they're all up, but again, not nearly as up as growth stocks, as reflected in those Magnificent Seven. How should we think about that, particularly given the research suggests that over the long term, both value and small caps should ultimately provide a premium return to the market overall. So give us some thoughts on that.
Yeah, as I think through it, when I look at the disparity between value and growth, it's actually surprisingly tight, given all the hoopla about the Magnificent Seven the last 4, 5, 6 months. That spread isn't really that large. I think when you dig below the surface and you look at underlying valuations in the growth in the value sector, growth stocks are relatively expensive. They're not where they were during the 90s bubble, but historically they're in the top decile valuation wise, whereas most value stocks are about as cheap as they've ever been. So I think from a valuation standpoint, that justifies maybe having a bit of a tilt towards value, that should set up value to outperform over the longer, next 3 to 5 years. What happens in the next month or two is anybody's guess. But I think over time, that valuation discrepancy should favor value stocks. Small cap, it's similar. So small has struggled with the tighter credit conditions because they rely on banks, a lot of banks for funding. Small is also cheap, but we're cautious on small just because the economic fundamentals there don't look as attractive. And that's similar for the international. We're underweight international stocks. And that sort of gets to the heart of the way we manage money. So we're broadly diversified under the idea that it's tough to predict which sectors are going to perform well in the coming years, but we do have some latitude to tilt one way or the other. So internationally, we've tilted in favor of the US against the international area, because we see some structural problems, particularly in Europe, that in my mind at least, are going to be tough to solve over the intermediate term.
Great.
Another way of how hard it is to predict the future, and what you get a lot of noise in the markets, and that doesn't necessarily predict where the markets are going to go. And just look at oil prices. So this shows you crude oil prices from the beginning of March 2022 through the end of December last year. So you can see where Russia invaded Ukraine, we had a big spike in oil. You can see when Hamas attacked Israel. And over that whole period, oil prices were down 22%. And so I think the layup trade in early 22 was to buy oil just on the geopolitical uncertainty. And actually, the markets have done the exact opposite. The best trade was actually to short oil. And I think going into an election year, we really need to focus on what impacts the markets. And so we'll have a lot of back and forth during the debates, the primary season, and the actual election runoff. But I think what ultimately impacts the markets is going to be where's economic growth is going, what happens with corporate earnings, what's happening with inflation, and what's the Fed doing with interest rates. And so, a lot of what goes on politically clearly has big societal implications, but not a lot of it has a big impact on the markets and the underlying fundamentals. And much of it depends on, can Congress pass legislation? And I think we've been in and are likely to be in a period of political gridlock where it's going to be hard to pass major legislation that impacts these 4 points. If you look historically at the correlation between who's in power and what happens to economic growth, there really is none. And so this chart shows you GDP growth from 1930 under different administrations or different parties, Democrat, Republican. And there is no correlation, right? It's hard over long periods of time, regardless of which party is in power, economic growth remains non-correlated to the political party. And it's the same for the markets. So this shows you the S&P under different administrations, Republican and Democrat. And again, there's little to no correlation between market returns and the party in power.
Charles, just an anecdotal comment here. You and I have had the same experience on this. I've had clients, I recollect when Trump was elected, they called and they said they just wanted out. You talk clients off the ledge. Some people trimmed their equity exposure. It was simply the wrong thing to do. The same thing happened when COVID hit, right? It goes back to that parade of horribles, of the bullet points of the start of the decade. And that's not a comment on Trump or Biden or any political party, but whatever your assessment is over the long term in terms of the movement of the markets, it's probably a bad idea to make any investment judgment decisions based on what's going on in politics at the moment, period.
I could agree more. Yep, great point. So looking at over the next 12 months, I think what will matter is what happens with inflation. And so I think we're in a period, at least for the next 6 to 9 months, where inflation continues to slow. So this is a chart of headline and core inflation. As I pointed out earlier, it's been cut in half from the highs, basically. And I think we're on track to roughly 2% type of inflation. And if that proves to be the case, I think the economic backdrop is one of a soft landing, meaning slowing inflation. I think growth remains robust. So we had the GDP number come out today for the fourth quarter. It was better than expected. So I think growth slows, but I think the odds of a recession are pretty low. So we sort of have a Goldilocks situation here for a while of slowing inflation and moderating growth. And if that proves to be the case, the Fed has room to cut interest rates. And so this chart is showing you where the Fed thinks interest rates will be in 2023. And so that's the green dotted line, horizontal dotted line. They're telling us they plan to cut rates 3 to 4 times this year. And that would help achieve that soft landing scenario of moderately decent growth, slowing inflation. And I think rate cuts would help the market confidence and provide a tailwind for the market.
There's also a tremendous amount of money in money market funds. I mean, trillions of dollars, right? Which market prognosticators think could roll into equities when rates get cut. Is that a reasonable assumption or thesis?
Yeah, roughly $1.3 trillion of cash flowed into money funds last year. That was the biggest inflow ever, even bigger than the amount that went in during the COVID stimulus of 2020. So you're looking at about $9 trillion in money funds and CDs. And I think you're right. At the margin, as rates come down, that's going to entice more of that money out of money funds and into bonds and stocks. And so, you know, the cash on the sideline idea is a bit of a misnomer, but I suspect that cash on the sideline is likely to be motivated to move into riskier assets. And we see that with clients, and you probably experience that as a client yourself, right? Carrying probably bigger money fund balances than you have historically just because you're earning some yield.
Right. There's no question. We're earning 5.25 on money markets for sizable balances. We don't charge a fee, so that's all net to clients. That is an ordinary income return, so there's a lot of tax leakage, but there's simply less opportunity cost today to be sitting in a sizable cash position. But as rates decline, I suspect a lot of that'll rotate in. If a lot of my clients are going to do it. So
I agree.
fair point.
I think we always read the headlines that the economy's on the cusp of a recession. There's always somebody out there preaching it. And I think the odds are relatively low this year. I think there's a tremendous amount of cash, as Tim pointed out before. Consumers have a lot of cash. They're going to continue to spend. Corporate America is flush with cash. They're spending a lot of the cash on capital investments. And I don't think we see a big change in fiscal spending. We don't see this big swing to austerity that we saw in 2011, 2012, until we get past Inauguration Day in January of 25, and whoever the new administration is starts nailing down their tax plans. So I think all of the signs for at least 6, 9, 12 months are that we should avoid recession. Growth could slow, but I don't think there's any big systemic imbalance that leads to a crack up like we saw in 2007, 2008. I think the more likely risk, and I wouldn't say this is my baseline risk for the next 12 months, but something we need to be aware of, is inflation comes back at the tail end of 24 going into 25. And much of this is a fiscal story. And so this chart is a little complicated. I'll just quickly walk through it, right? The horizontal axis shows you unemployment. The vertical axis shows you budget deficits. And so the story here is basically we've never run such large fiscal deficits when unemployment is as low as it is. And obviously, a lot of that in 2020, 21, 22 was in response to COVID. I think 23 is the outlier, that the deficit is as large as it is. And a lot of that, or a good portion of that, is going into things like infrastructure investments, alternative energy build outs. There's the CHIPS plan, right, to build fabrication plants in the United States. And as I say, I think this continues. I don't think either political party is inclined to cut the deficit significantly. And if the labor market stays tight, deficit spending remains where it is, there's a risk, and maybe it's a 1 in 3 chance, we see an inflation upsurge tail end of this year or in 2025. We're not positioning for it because I don't think it's the base case, but it's definitely something we're watching at the moment, and we'll adjust the allocations accordingly if it looks like it's coming down the pike. So pull it all together, our base case on the economy is the soft landing scenario. The markets rallied in the fourth quarter of last year to price this in. We've had a relatively decent beginning of the year. But I don't think the moves we've had preclude more modest gains going forward, particularly when we start to see rate cuts in March or June, which seems likely at the moment. And that should support the capital markets, lead to further gains for stocks and bonds. Not what we saw last year, more modest, but I think still positive under that soft landing scenario. I'm more worried about inflation than recession, but I don't see it as likely, at least in the first 6 months of this year. And I think the key message we're trying to convey, though, is, the election news is going to be crazy, probably, more volatile, crazier than we saw in 2020. There's going to be a lot of sort of headlines tugging at your emotions to do something. And I think the key is to tune out the noise when it comes to investment portfolio and focus on the fundamentals. If we're still in a world of declining inflation, moderating growth, but positive growth, and Fed rate cuts, that should be supportive for the capital markets.
Great. Charles, that's the perfect last bullet point. It's a synopsis of my entire investment philosophy. So it's a great way to end. So thank you. So thanks, Charles. And then for my clients and friends, as always, call us anytime. Thanks, Charles.
Thanks, everybody.